You might think the cash sitting in your brokerage account is automatically protected by SIPC, but in the past few years, many firms have quietly shifted that free credit balance into automatic sweep vehicles that carry entirely different risks. Instead of leaving your uninvested dollars in an account covered by SIPC's $500,000 protection, your broker-dealer now sweeps that money into linked deposit accounts or money market funds, sometimes without clear notice or your explicit consent. On paper, this sweep sounds like a benefit. You earn a bit of interest instead of letting cash sit idle. In practice, however, you've just moved your safety net from a federally backed insurance regime to whatever risk profile the sweep vehicle carries. If the sweep lands your funds in an FDIC-insured bank account, you're still limited to $250,000 per institution. For a retiree with 6 figures parked in cash, it's dangerously easy to exceed that limit without realizing it. And for those sweep programs routed offshore as Eurodollars, there's no FDIC coverage at all. You become an unsecured creditor of a foreign affiliate, exposing your savings to currency swings, affiliate defaults, or legal uncertainties if that bank runs into trouble. Even money market fund sweeps aren't bulletproof. These vehicles can experience net asset value drops in stress markets, and while they aim to maintain a $1 NAV, they're not government guaranteed. All of this can happen by default whenever your account bounces back from an executed trade or uninvested dividend. So rather than actively choosing where your cash goes, you may wake up one morning to find 6 months' worth of income swept into a vehicle you never signed up for. For retirees who count on cash stability, that lack of transparency feels like a hidden door left ajar. Your money isn't missing yet, but the exit is only a bank run away, and you might not even know which vehicle holds your life savings. Most investors assume that a sweep into a bank deposit must mean FDIC coverage, but a growing number of firms have flipped the script by routing cash into Eurodollar sweep accounts, which pay slightly higher yields in exchange for offshore risk. These Eurodollar sweeps place your dollars in an affiliated entity outside the US, where FDIC protection doesn't exist. That tiny extra 0.1% or 0.2% yield can come at a massive cost if the bank affiliate faces financial distress or if diplomatic or legal disputes complicate your claim. Unlike a domestic deposit, you become an unsecured creditor of a foreign arm, reliant on the local laws and courts of a jurisdiction you might never have heard of. During the 2008 crisis, some Eurodollar obligations traded at steep discounts when investors questioned the creditworthiness of offshore affiliates. In effect, what you thought was a safe cash position suddenly looked more like speculative corporate debt. And because these programs are often buried in account disclosures or buried deeper in the sweep options menu, retirees rarely realize their cash has effectively disappeared from U.S. insurance regimes. You don't get a periodic notice that today your cash moved to an offshore sweep. It happens invisibly whenever new cash settles. So while you rest easy believing your emergency fund is secure, a banking crisis overseas or a change in cross-border regulations could leave you waiting in line behind other creditors with no priority claim. The yield might seem tempting, but that incremental interest doesn't compensate for the risk of having zero guarantee that you can reclaim every dollar of your savings. And during a liquidity crunch, those Eurodollars can become the hardest money of all to convert back into dollars you can actually use. Repo sweep accounts might sound like a clever way to get a slightly higher yield on idle cash, but they come with hidden complexities that can backfire when markets get rocky. In a repo sweep, your broker-dealer ostensibly lends your cash overnight to a bank or other financial institution in exchange for high-quality securities, typically treasury or agency bonds, as collateral. On paper, this promises minimal credit risk since the collateral should always exceed the cash loan. Yet in stressed markets, the value of that collateral can swing dramatically, triggering margin calls or forced liquidations at depressed prices. If the dealer or bank counterparty can't meet those calls, you're left holding the bag. And unlike FDIC-insured deposits, there's no guarantee you'll recover your principal. What many retirees don't realize is that these repo arrangements operate under master repurchase agreements that prioritize secured creditors, not retail account holders. When trouble hits, say a sudden sell-off in treasury or mortgage bonds, counterparties scramble to post fresh collateral, and your overnight sweep can morph into a multi-day headache. You may be unable to redeem cash at par, forced instead to wait for collateral to be sold at auction, potentially at a loss. Meanwhile, the yield you earn can vanish in a single session if the repo facility imposes haircuts or suspends transactions. Furthermore, repo sweep programs aren't standardized. Some use tri-party clearing banks, others rely on bilateral agreements. Few brokers volunteer a clear roadmap. You often have to dig through fine print disclosures to find out which counterparties you're exposed to and what collateral they accept. That opacity can leave you blind to concentration risk. Your entire emergency fund could be lent to a handful of institutions, any one of which could face liquidity stress in a downturn. And here's the final twist. Because repo collateral is marked to market daily, a rapid drop in bond prices can force frequent recalibrations of how much cash you can borrow against it. In extreme scenarios, repos have been unwound en masse, creating a cascade of redemptions that leave cash sweep customers waiting longer for funds than they bargained for. When automatic sweeps shift your safety net into these repo vehicles, the small bump in interest isn't free. It trades simplicity and certainty for complexity and operational risk, exactly the opposite of what most retirees need. And just when you think you've found a safe haven, this twist can catch you off guard. Most retirees assume that money market fund is synonymous with risk-free, but when your cash is swept into a money market sweep vehicle, the reality is far murkier than FDIC insurance. These funds aim to maintain a stable $1 net asset value (NAV), and in calm markets they succeed. But when stress hits, like in 2008 or during the March 2020 liquidity squeeze, some funds break the buck, meaning their NAV dips below $1. Suddenly, that emergency cushion you counted on is worth less than face value, and you're absorbing a loss. Unlike bank deposits, money market funds don't carry FDIC coverage. They're regulated under SEC rules that prioritize diversification and liquidity, but not a government backstop. In a sweep program, your brokerage or advisory platform automatically funnels uninvested cash into these funds, perhaps broad-based prime funds or retail-class municipal funds, without pausing to warn you about the lack of deposit insurance. You might see the fund's ticker in your account statement, but few retirees know to ask what happens if the NAV slips or the fund's manager imposes a fee to stabilize the price. What makes this especially insidious is how sweep programs advertise daily liquidity and stable returns, lulling account holders into thinking they're getting both safety and yield. In reality, the yield comes from short-term commercial paper, repurchase agreements, and other instruments that can freeze up or lose value if a major issuer defaults. During a crisis, the fund's board might waive fees or temporarily suspend redemptions to protect long-term investors, leaving swept cash unavailable exactly when you need it most. Furthermore, sweep options often default to the firm's proprietary or affiliated money market fund, where fee waivers and yield support agreements can evaporate overnight if the manager decides the program isn't profitable. That means your sweep yield could plummet mid-year, while your account notice simply reports a lower yield figure rather than warning of reduced liquidity or potential NAV instability. For retirees who equate money market with FDIC insured, this hidden vulnerability is a trap. You're trading the certainty of a government guarantee for a promise of stability that's only as strong as the fund's underlying holdings and the manager's discretion. And if the next market shock hits, you may discover that your cash has less protection and less value than you ever imagined. You thought that sweep yields advertised in your account statement were rock solid, but behind the scenes, some of the biggest firms have been quietly shortchanging retirees on interest, and investors are finally fighting back. Several major broker-dealers and wealth managers have faced class action lawsuits alleging that the sweep programs they touted at 0.5% or even 1% actually paid clients, as little as 1/21st of that rate once the firms pocketed their float. In these cases, plaintiffs claim that the firm structured sweep agreements to retain the lion's share of the interest margin, leaving customers with mere pennies on the dollar and no clear explanation. What makes this practice so insidious is how sweep yields are buried in fine print and blended into account summaries. Retirees glance at a headline rate, assume their emergency fund is earning that return, and never realize until tax time or a forced redemption that the actual credit was a fraction of what they expected. When the lawsuit surfaced, court filings revealed internal emails showing executives celebrating the extra revenue sweep floats generated, even as relationship managers told clients they were getting best-in-class returns. Regulators have since opened probes, and some firms have agreed to multi-million-dollar settlements to avoid protracted litigation. But those payouts barely cover the lost decades of compounding for an average retiree. Even more alarming, these cases expose how little transparency exists around sweep programs. Clients often don't discover the discrepancy until they receive Form 1099-T and see that the interest credited falls far short of the rates promised in marketing materials. The crises have prompted several firms to overhaul their sweep disclosures and, in some cases, raise yields to pacify customers and fend off further legal action. But for every settlement, there's a retiree whose nest egg earned far less than they believed, and the emotional fallout of feeling betrayed by the very institutions meant to protect their savings. If your broker or advisory platform hasn't recently alerted you to a change in sweep yields or disclosed the float structure, consider asking hard questions or seeking an independent review. Because when the next class action hits, you don't want to be the last to know that your own emergency fund was used to enrich someone else's bottom line. Regulators have started zeroing in on these sweep programs, and that scrutiny could translate into real headaches, or even sudden yield cuts, for retirees who've parked their cash without realizing the risks. In early 2025, Moody's issued a warning that ongoing probes by the SEC and banking regulators into broker-dealer cash sweep practices could weaken the credit ratings of some wealth management firms. When a firm's rating drops, its cost of funding rises, and guess who ultimately picks up that tab? Yep, clients. Firms facing higher borrowing costs or potential fines may slash sweep yields across the board, alter the mechanics of which vehicles they use, including shifting from insured programs to unprotected ones, or quietly pull back support agreements that backstop money market funds. None of this comes with a friendly, "Hey, we're lowering your rate" email. You'll just see your sweep return tick down on your statement. Even more alarming, a credit downgrade can undermine the perceived stability of the sweep partner banks or funds themselves. If Moody's or another rating agency downgrades a custodian bank that holds your swept cash, it may trigger contract clauses that pivot your sweep into a lower-yielding safety-first vehicle, or worse, force you to opt out entirely. And if enough clients decide to pull their cash after hearing about regulatory troubles, it could create a run-like scenario where the very liquidity retirees count on dries up. Beyond ratings, regulators are considering new rules to require clearer disclosures and even limit the kinds of sweep vehicles firms can offer by default. That could mean mandatory FDIC-only options, caps on the amount that can be swept offshore, or higher capital charges on repo arrangements. While these reforms sound protective in theory, during the transition period, they could lead firms to disable all sweep options temporarily or push clients into lower-yield, bank-insured buckets, again, without any real market warning. For retirees, the takeaway is simple. Don't assume today's sweep arrangement will survive tomorrow's regulatory storm. The next regulatory shakeup could force changes that cost you yield, liquidity, or both, and you might not have time to react. Check your platform's credit ratings. Ask how much of your cash goes into each sweep vehicle, and consider manually selecting an FDIC-insured option to lock in clarity, even if it means a slightly lower return. Because when regulators tighten the screws, the silent cuts they implement can leave your retirement income strategy hanging in the balance. Nearly half of all bank deposits in the U.S. now sit above the FDIC's $250,000 insurance limit, and a growing slice of those uninsured funds is funneled through sweep arrangements without retirees even realizing it. When your broker or advisory platform sweeps uninvested cash into multiple partner banks, it may spread small balances across institutions to dodge the $250,000 cap until deposits grow or the pairing changes, and suddenly your life savings leaves the safety net behind. In a normal world, an uninsured deposit is just a minor risk, but when large pools of cash move in lockstep, think thousands of retirees' emergency funds flooding into the same few regional banks. Any dip in confidence can spark a scramble to withdraw. Remember how quickly word spread during the 2023 regional bank turmoil? Lines formed, digital withdrawals spiked, and even well-capitalized banks faced liquidity crunches. For retirees, that scenario is especially dangerous. You rely on daily access to your cash and can't afford a multi-day hold or a payout delay while the bank unwinds its balance sheet. What makes uninsured run risk so insidious is its invisibility. Your online dashboard still shows your full balance, but that number hides the fact that those dollars aren't covered by FDIC, SIPC, or any guarantee. During the next banking scare, wind-down provisions could limit how fast sweep funds are returned, leaving you stranded with dry checking accounts and no fallback. Worst of all, banks may implement transaction caps, forcing partial withdrawals or prioritizing institutional clients over retail account holders. In a true run, regulators have the power to impose withdrawal restrictions or convert uninsured deposits into equity to recapitalize a failing bank, moves that can permanently erode your principal. The data is clear. As uninsured deposits hit record highs, the probability of run dynamics grows. And while regulators may debate patchwork reforms or encourage bank holding company structures for broker-dealers, those fixes will take years to implement. In the meantime, every dollar parked in an uninsured sweep is a ticking clock. If you haven't audited your sweep counterparties, slice your balances to stay under insurance limits, or shifted to explicitly FDIC-backed options, you could see your emergency fund locked up the moment market jitters start. To sleep soundly, you need clarity today about where every penny resides, and peace of mind that even if the system falters, your retirement cash remains in your hands, not tied up in a bank survival plan. Before you let an automatic sweep program hijack your safety net, take control with these critical steps. First, identify your default sweep vehicle by logging into your account and checking where uninvested cash lands. Don't assume it's FDIC insured. Look for program names like Eurodollar, Repo, or the specific money market fund ticker. Next, manually select an FDIC insured option whenever possible. Most platforms let you choose from a menu of sweep vehicles. Opt for deposit accounts backed by FDIC at multiple partner banks, and spread your balances so no single institution exceeds the $250,000 limit. Then, audit your yield versus credit rating risk. If a sweep pays noticeably more than the national average, dig into the fine print. Higher yield often signals higher risk. Check the custodian's Moody's or S&P rating, and ask whether those deposits count as senior unsecured obligations or collateralized repos. If regulators target that firm, a downgrade could cut your sweep yield or liquidity overnight. Third, set regular reviews, at least quarterly, to ensure your sweep settings haven't changed. Custodians sometimes switch default programs or tweak fund lineups without explicit notice. A simple quarterly sweep check can catch these shifts before your cash moves into a riskier vehicle. Fourth, keep a small cushion in an external standalone account, a traditional bank savings, or a credit union share account, to ensure you always have immediate, fully insured funds. That way, even if a sweep vehicle freezes or NAV dips, you won't be stranded without cash for essentials. Fifth, consider laddering short-term CDs or I-bonds as alternatives for part of your emergency fund. These instruments carry built-in insurance and predictable returns, and staggering maturities gives you liquidity on your timetable rather than the custodians. Finally, talk to an independent advisor or fiduciary who isn't paid by the sweep provider. Ask for a full breakdown of your cash management options, request disclosures on credit risk and insurance, and insist on written confirmation of your selections. By taking these actions, identifying defaults, choosing FDIC coverage, diversifying, auditing yields, scheduling reviews, maintaining an external cushion, exploring alternatives, and consulting an unbiased expert, you'll shield your nest egg from hidden sweep dangers. Your retirement cash deserves certainty, not surprises. So lock down your protection today before the next banking shock tests your liquidity.